presenter today.
Thank you, Kyle. So for today's presentation, we're going to have three great presentations, hopefully. It will be myself going first, talking about the 2020 Dairy Farm Summary, which is a review of the financial results of dairy farms in the Northeast last year. Then Jeremy Forrett of Crop Growers is going to be talking about risk management options and strategies for dairy farms going forward. And then finally, Catherine Ronde of Agri-Mark is going to be giving us a price and market outlook for the remainder of 2021 and what we might be able to expect in dairy markets going forward. So we're going to have a look back as well as a look ahead today. Just briefly, we have the mandatory disclaimer that this information is presented in good faith, but you should not be making major decisions based on it without consulting with your business advisors. And I guess we will go ahead with the presentations. Okay. Let me know when you can see my screen, Kyle.
So Chris, we can see your GoToWebinar thing. So we need, yep, there's your presentation. You're all good to go. You're all good to go.
Okay, great, thank you very much. So as I mentioned, the 2020 Dairy Farm Summary is a look back at the year that was and how dairy farms in the Northeast states of New England, New York, and New Jersey handled what was really a remarkable year. Certainly the most unusual year I think any of us have ever seen. And we'll talk about that. As I mentioned, I'm going to review the financial results. Jeremy will follow with his dairy risk management, and then Catherine. And then we'll have time for some Q&A following, because I think it was certainly a really interesting year and a really remarkable year. And, you know, that uncertainty and that kind of time continues. COVID has not gone away completely. Many of the restrictions have been lifted, but there's still some market uncertainty going forward. So hopefully we'll have some good discussion. So some key points from the year that was in 2020. We had 209 dairy farm participants, mainly from New York, but from other states as well, that agreed to share their financial results with us so we could sort of analyze them and slice and dice them in various ways and present the Dairy Farm Summary report. 209 farms makes for a remarkably robust analysis of the Northeast dairy industry. It's a large sample. It allows us to analyze the data in a number of different ways, and it reduces the chances of having the numbers skewed by outliers within the industry. As I will present a little bit later, the results in any given year tend to vary quite a bit. There are some farms that are doing remarkably well. There's a bulk of farms that kind of make up the average, and then there's other farms that struggle. And that's true in almost any year. And so having a large sample sort of minimizes the impact of those outliers and allows us to really present what we feel is a solid cross-section of what I would say is larger and likely more profitable farms than the true average in the region. So we really appreciate the industry support that makes this analysis possible. And it's also a testament to the large number of Farm Credit East staff who work on this project, compiling the data from all these farms and getting it in a timely fashion. It's important to note that, as I said, our sample does skew significantly larger than the average dairy farm for the region. The Ag Census tells us that there is a large number of small dairy farms in the region, which makes the average herd size about 135 cows. Our sample average was 685, significantly larger than that. So we're sort of oversampling the large farms and undersampling the smaller ones, if you will. However, we do break our results down into 4 size categories: 0 to 99 cows, 1 to 300, 3 to 7, and 700 and up, so that readers can see data for the size group that they're interested in looking at. And we have a good sample size of each size category, so you can see kind of the different business models in the dairy industry and how each of them fared profit-wise. Profitability significantly increased in 2020. The average came to $663 per cow, which is one of the best years we've had. Well, actually the best year since 2014. So it's the best in like 6 years. Government payments were a significant chunk of that. And as you can see in the report, government payments, primarily the CFAP program, which was very generous. That stands for Coronavirus Food Assistance Program, and it was administered through USDA. There were 2 rounds of it last year, and that amounted to $565 per cow on average. So you can see how much of a chunk of the net earnings came from government payments. If there were not those government support programs, it would have still been a profitable year for the average dairy farm, for most dairy farms in the Northeast, but that profitability would have been much more limited. The milk price, as you can see, was 70 cents below 2019's average. Much of that was due to basically a price crash in the first half of the year due to the COVID-19 market disruptions, which I'll get into in a minute. Net cost of production increased somewhat from 2019 by 30 cents to 18.11. So luckily the milk price exceeded the net cost of production, so there was a profit margin there. Not a huge one, but it was, it was there, and it helped farms have positive net earnings. And total debt per cow declined slightly to just under $4,000 per cow. I'll talk about that a little bit at the end. That decrease was basically a function of the fact that we had a higher average herd size, so basically more cows to spread the debt around, more than a reduction in the amount of debt that per farm, if you will. So looking at farm milk prices in the Northeast, you can see the average price received per year as well as the 5-year average. We can see the peak in 2014, obviously a remarkable year then, and then the pretty significant decline in the following 5 years. Since 2015, prices have basically bounced up and down between $16 and $19 in a rather limited range there, with 2019 representing a 5-year high, and then 2020 seeing a modest decline, again, basically due to that price crash in April and May of last year. Net earnings per cow have fluctuated significantly, as you might expect, with milk price fluctuating significantly. You can see the peaks in various years, but in general, we seem to often kind of return to that sort of break-even baseline with periods of profitability in between. One reason for this is that there's basically a disconnect in, in most agricultural markets, including dairy, between the macro and the micro, meaning that what's often good for individual producers sometimes is not great for the industry at large. And what that means is basically when earnings are high, farms tend to increase production, which makes sense for them individually, but that often shifts the balance of supply and demand more broadly and results in lower prices. 2020 earnings, as I mentioned, represents a 6-year high. You can see that on the right-hand side of the screen. And that means that marks a 3-year uptrend since 2018, which was a shallow loss. So we can't talk about last year without talking about supply chain disruptions due to COVID-19. Before COVID-19, roughly half of all food was eaten outside the home in our society. Things like schools, restaurants, universities, you name it, institutions, represented a significant portion of the food that we consumed outside the home, and the supply chains had adjusted over many years to fit that market, where about half went through grocery store retailers and about half went wholesale through food distributors into food service markets. And that had evolved, as I said, over quite a long period of time. And then the food service market virtually disappeared over just a few weeks, which was really pretty remarkable. The processing system struggled to adjust, and there were a lot of news articles about a broken food system, how fragile our supply chains are, and there were, of course, hundreds of articles about dumping milk, and people talked about how our food supply chain was not resilient and that kind of thing. But I actually had somewhat of a different takeaway. I think that supply chains actually adapted relatively quickly to what was really a major disruption. I mean, I don't know how many industries out there could handle essentially losing half of their market in about 3 weeks. or at least shifting that market. Grocery retailing increased while food service decreased, and both of those were substantial. And the food system had to, the food system more largely, and dairy in particular, had to adjust to that in a very short period of time with virtually no warning. And it was, I think pretty remarkable how quickly and how effectively that adjustment occurred, but it was not without some short-term pain. And I'll talk about that in a minute. So here's the pain, if you will. The USDA all milk price really crashed in April and May of 2020 as a result of the COVID-19 and supply chain disruptions. As early as November of 19, we had a peak in price, and then as early as December, prices started to decline. Some of that may have been due to kind of a seasonal decline, but we were already hearing news of market disruptions and that sort of thing, and COVID-19 coming out of China at that point. And then in January and February, we started to see cases and outbreaks in the United States. And then, of course, in late March, we had the shutdowns of restaurants and that sort of thing, which led to a severe decline in price for April and May. And we had, went below $14 a hundredweight, which is way below pretty much anyone's cost of production. So virtually all farms lost money. Many farms had to dump milk. Thankfully, most of that dump milk was pooled, so that individual farm didn't have to take a complete loss. But it still, hurt kind of everyone through the pricing. And then as quickly as June, we started to see a pretty remarkable recovery. Prices went back up and peaked in July, close to where they were for 2019's peak, and then some fluctuation after that. So here is basically the reason for the crash that we saw in April and May of last year. Just a remarkable amount of milk had to be dumped in April. You can see there's a relatively modest baseline of milk that's dumped for a number of reasons on kind of an ongoing basis. That's the low bars in most months before and after. And then of course, the huge hit in April. But notice that by May, that dumping had largely subsided. It took a little while for prices to recover again, but through some supply management and through adoption or adaptation of processing facilities and supply chains, that was largely resolved in basically 1 month. So, as I said, I think the story is, yes, that supply chain disruptions were significant, but that the industry really adapted pretty quickly to what was an unprecedented and major disruption. There's no inventory that could be built of fluid milk coming into the supply chain. It has to be processed virtually immediately. So there was no ability to store anything, and unfortunately, that milk had to be dumped. But it was the system kind of adapted quickly. So getting back to net cost of production. If you can see here, this is the 15 through 20, and 2020 is on the right-hand side of your screen. Cash expenses tend to follow milk price to a large extent. And what that means is not that farms kind of try to spend everything they can get. It's more of a case of, in a good year, farms catch up on deferred maintenance, and in a down year, if you don't have it, you don't spend it. You economize on things, you put off that new roof on the barn that you might need. The big tractor repair, perhaps, that kind of thing. So in 2020, with the larger cash availability, cash expenses increased accordingly. Depreciation declined basically because that's a fixed expense, and our herd size increased, so it was spread out over more cows, essentially. Or more hundredweight, rather, in this chart. Similarly with family living, that's a fixed expense, and that was diluted by a larger herd size. But farms did not, increase their family living just because they had more income. They pretty much stayed the same. And most of that income was used to reinvest in the business, in their businesses, pay down some debt perhaps, and as I said, reinvest in the business, short financials, that kind of thing. So 2079 represents the total cost that each dairy farm had per hundredweight produced. From that, we subtract non-milk farm income, and that's things like crop and livestock sales, as well as ancillary revenues tied to the business, like things like maple sugaring or other affiliated business ventures. These are more significant on the smaller herd sizes where you sometimes have more diverse farms. These can be tough to separate from the core dairy business because labor costs are usually combined. So when we're doing net cost of production, we basically take out the non-milk farm business income and we come up with the net cost of production, which we came to 1811 for last year. As you can see, the net cost of production, we often talk about it like it's one number, but it's really important to note that each farm has its own unique net cost of production based on its individual characteristics and its cost structure. The pattern of net cost of production tends to follow a bell-shaped curve with a cluster in the middle and tails of outliers on each side. In this chart, farms on the left-hand side of the screen have lower costs of production and are likely to have higher earnings, while those on the right-hand side of the screen have higher costs of production per hundredweight and are likely to have lower or negative earnings. And these farms unfortunately tend to drop out over time. We can see here a regional analysis of net cost of production for 2019 and 2020 for New England and New York. New England farms generally have higher costs than their counterparts in New York, even when adjusted for size differences. Sometimes New England farms have a smaller herd size, although that's not always the case because New York has a lot of small herd sizes as well. But basically every line item tends to be just a little bit more expensive in New York, particularly purchased feed and labor. And non-milk income is generally lower as well because farms tend to have fewer acres to grow surplus crops. Surplus crop sales are typically a fairly substantial line item for a lot of New York farms. One thing to note is that labor costs, they increased in New York by a little bit, but that's a little bit deceptive. They actually increased, family labor is often unpaid or paid below market rates. And particularly in the smaller herd sizes, that impact is substantial on lowering their labor costs per cow and per hundredweight. So if you look at only farms with paid hired labor, their labor costs actually increased more substantially than what's indicated here. And I talk about that in the Dairy Farm Summary Report. Some of that is due to market forces on labor availability and cost to hire people. Some of it's due to legislative changes in New York that required overtime over 60 hours, day of rest, and some other restrictions on labor that made operations more costly. In New York, there was actually a reduction in labor costs. I attribute that more to changes in the sample of the farms. Unfortunately, we didn't have a very large sample of farms in 2020 in New England. We came to only 13 farms, so I'm not sure that difference of 431 and 395, I'm not sure that that's statistically significant or truly representative of labor costs in New England. I really don't think that they went down per hour for hired labor. I think that might be a little bit of efficiency gains there, but I attribute that more to changes in the sample, if you will. So as I mentioned, we tend to have a wide range of results for farms. While the average farm had $663 in profits per cow last year, the bottom quartile of farms, if we separate it out by earnings, had losses of $74 per cow, while in turn the top profit quartile had a very good year with nearly $1,300 in net earnings per cow. And while it may seem obvious, positive net earnings are essential for any farm to remain viable. And while the average farm, as you can see in the chart here, had $450,000 in net income, that doesn't really mean that they put $450,000 in their pocket, so to speak. Those net earnings are needed to cover debt payments. Remember that interest paid is a deductible business expense, but principal payments have to come out of earnings. So there's a substantial chunk of earnings there that come out of, substantial chunk that comes out of those earnings to pay back principal payments. And those earnings are also required for reinvestment in the business, capital improvements, again, which are comes out of earnings, and then contributions to things like retirement savings and cash reserves for the farmers themselves. So that's basically where those earnings go. Much of the positive earnings that we saw in 2020 were reinvested in the farms into their operations and their facilities. Here's a look at earnings per hundredweight on an accrual basis, which is accounting for things like depreciation and inventory changes, deferred milk checks, that kind of thing. It does not include debt principal payments. And you'll notice relatively flat level of costs over time if you look at the variable costs and fixed costs. And that's influenced by a few things. The increasing size of farms in our sample and subsequent economies of scale are a factor there. And it's worth noting also that this chart is not adjusted for inflation. So these farms and having relatively flat costs indicate substantial efficiency increases and belt tightening, if you will, because this occurs against a backdrop of modest but steady inflation over the same period. So farmers have managed to keep costs basically flat against a backdrop of increasing input costs. This chart looks at cash flow rather than accrual earnings. So it does not account for non-cash items like depreciation, but it does cover debt service, including principal payments. And you'll see that in every year, the cash required per hundredweight of milk exceeded the price paid for that milk. So farmers rely on that other income line to reach their break-even point, which includes things like crop and livestock sales, as well as some of those ancillary business activities, particularly for smaller farms. And another thing that's notable on here is that you can look that farms really didn't have any extra cash at all for 4 years in a row. So the last 2 years of earnings, positive cash earnings, if you will, were really a chance to catch up on expenses that have been put off during leaner years. And this just shows graphically what we looked at in the previous table. It's been a bit of a tough stretch for cash flow, at least, to say the least, for 4 years in a row there. So how have farms made ends meet during this period? One way is through increased borrowing. So this chart shows the average total liabilities per cow of farms in our sample over the last 41 years. This is total liabilities, so not just bank loans, but things like trade credit, any kind of all liabilities, all things that farms owe, whether it's short-term or long-term. And it's per cow, not per farm, so that allows us to get past differences in farm sizes. Notable to look at in this chart is that if we go back to 1979, we were just under $2,000 per cow. It took 29 years for average debt per cow to climb from $2,000 to $3,000, but only 8 years to break to $4,000, where things have basically plateaued since then. Now, of course, there's impact from inflation over this period, but I think it's remarkable that debt per cow took such a long time to increase, for a very long period of time, and then really kind of jumped in just a few years. So that it's noteworthy. I don't know as I would go so far as to say that it's a crisis level or deeply concerning, but it is something to consider that farms are carrying significantly more debt than they used to carry in the past. If we adjust things for inflation, we can see in the blue line that farms have had high levels of leverage in the past, but we really have to go all the way back to the 1980s to get there. And for those of you that remember the 1980s, it was not necessarily a great time for a lot of agriculture. So as I said, I don't think we're at a crisis point or anything in terms of dairy farm debt, at least on an average for most farms. But increasing leverage does limit the flexibility of farms, and it can make volatility of prices and input costs harder to take. And particularly because these debt payments don't go away when milk prices drop or input costs increase. I'm a little over time, so I'm going to go quickly through the next couple of slides, but this shows farm liquidity. The blue line is what we call current ratio, and that basically looks at current assets compared to current liabilities. So what farms have in assets compared to what they owe. A level of 1 would mean that that's equal. The kind of standard is you want that to be above 2, which means that you have double the assets as liabilities. However, because on an average dairy farm, a lot of current assets is feed inventory, which needs to be converted to milk in order to pay bills with it. We also look at what we call the quick ratio, and that's basically cash equivalents essentially, or things that can be quickly made into cash versus liabilities. And we can, when that dips below 1, that's a little bit of a concern, because that means that farms have to hold bills and wait for revenue to come in to pay them. And we can see that in 2016, 17, and 18, farms were in that situation where money was, cash was extremely tight. 2019, we reached that 1-to-1 ratio where farms had essentially as much cash as they owed. And in 2020, it was more robust at 1.5, which is kind of an industry standard you might want to see in other industries. So dairy farms got in a better cash position last year, but that follows a stretch of some tough years. So final takeaways. As I said, the COVID-19 pandemic significantly disrupted dairy markets, but supply chains were able to adapt. Although there was pain felt, there was milk dumped and low prices for a few months. Profitability improved significantly. However, government payments represented a big chunk of that. A wide range of results financially continue. The average farm size continues to grow in the region. And we did see positive correlations in the report between farm size and profitability, but it wasn't a straight line. It wasn't a guarantee that all large farms did well. And in fact, only 1/3 of the top size quartile farms made the top profit quartile, meaning that some of those large farms had just average earnings and some of them even lost money. Positive cash flow continues, but some farms are still recovering from their balance sheets. And there's some question marks about what's going to happen without the government support we had last year. Last year was really a unique year. I don't think we're going to see that kind of support again. And I think we can talk about that a little bit going forward in terms of managing risk and price outlook. So with that, we will go to the next presenter, but at farmcrediteast.com/reports, you can download the full dairy farm summary. It's about 50 pages, and you can get a lot more detail than what I was able to present today. So with that, I'll kick it back to Kyle, and we'll go on to the next.
Great. Thank you, Chris, and thank you for having me today. Good morning, everyone. It is great to be with all of you today. I'm looking forward to our discussion that we have on dairy risk management and the products that we all have available to deliver to you as you run your businesses. As we all experienced a dairy market with much uncertainty and volatility in 2020, many producers realized the value of having a sound risk management plan in place. They also recognized how important a relationship with a knowledgeable crop insurance agent that specializes in dairy risk management can be to their businesses. While volatility creates opportunity, having reliable, available risk management products that allow you to maximize profit by allowing you to capture upward market price movement while establishing a price floor to reduce risk. This is really the new dairy risk management strategy, and what we're going to cover is the 3 programs that are available that you have options for. One being the dairy revenue protection, known as DRP, the other livestock gross margin dairy, known as LGM-Dairy, and then dairy margin coverage, DMC. We'll start with the dairy revenue protection program, and this program was introduced in 2018 and is considered the product that really revolutionized dairy risk management. This product continues to grow in usage with over 30% of the US milk production currently enrolled, just in a matter of 3 years. And in the Northeast specifically, we have just about 4 billion pounds of milk enrolled, providing just over $700 million worth of market protection. This is a great story as we look at how this product came into the market, how dairy producers quickly learned how this product works, and the industry delivered it successfully to the dairy industry. This product is available through crop insurance agents. It protects against unexpected decline in revenue. We'll get into a little more detail, but price and or yield. One very important benefit of this program is it has a daily enrollment option. So from a dairy producer perspective, as long as there are milk prices that are released and there's no USDA reports, Monday through Friday, you have the option to be able to look at the market, look at the product, and decide, is it time to enroll a portion of milk? Coverage levels range from 80 to 95%. So what does that mean? At the 95% coverage level, that means that you have a 5% deductible from the price that's available. So whether it's class 3, class 4, or your component values, you have the option to locking in a price well into the future at 95% coverage level. I'll say that approximately, and I'm probably going to vary here a little bit, between 98 to 99% of the milk enrolled is at the 95% coverage level. One of the benefits of the program is, as we're looking at the futures, we actually have the ability to protect up to 5 nearby quarters. So example, if today's market looks good, you reach out to your crop growers agent, you'll have available to you in class 3 and class 4 pricing that goes out to the 3rd quarter of 2022. That can bring you a lot of peace of mind, and we'll get into that as we wrap up and talk about developing that dairy risk management plan for your personal business. Premium support makes the coverage very affordable. You can see here that the premium support is up to 55%. So what that means is what the premium would typically cost through the support of USDA, you're paying about half of the actual premium. We'll move on to the Livestock Gross Margin Dairy Program. This program was introduced in 2008. This program gained a lot of interest when it became available, and then again in 2012 and 2013 when feed prices were at a high point. Well, here we are once again, looking at higher feed costs, not certain as to how long these feed prices, corn and soybean prices, are going to remain this high, or how much higher are they going to go? But making this program today even more attractive as we look at the second half of 2021 and into 2022. So this program takes into account, from a dairy perspective, dairy business perspective, both sides of the equation as feed costs protecting if they rise, or milk prices to drop. So this really brings a all-encompassing risk management plan as it relates to margin, protecting feed costs, and milk price. Probably just announced on this webinar, but really excited to share that LGM-Dairy for the 2022 crop year, which actually begins July 1st of 2021, we moved to a weekly sales closing. So if anyone's familiar with LGM-Dairy in the past, we really had one opportunity per month, the last business Friday, and now we're moving to a weekly enrollment opportunity. So really excited about that. We have an enrollment for this Friday to end out the 2021 crop year, and then the following Thursday we'll have an opportunity to enroll weekly with the 2022 crop year, which again begins July 1. Coverage levels, which are really deductibles for this program, range from 0 cents up to $2 per hundredweight. What we'll typically see, and I don't want to influence, but just give a little perspective here on what we see for producers typically participating in LGM-Dairy, is the dollar deductible tends to be something to really look at, very affordable in cost, And if you've got milk price minus feed cost at, let's say $13, and you have a $1 deductible, that means that you'd have to, the market, either feed costs going up or milk price going down, fall below $12, and the program would kick in and start to respond and offset those losses back to you. Again, feed cost driven and milk price driven, so both factors playing in here. And for what's available for coverage, we're always looking out 11 months. So the following month, so we would not be able to enroll in July, milk in July. So our first opportunity would be August. And then we roll out to, I believe that's June of next year. So forward thinking, looking at futures for both milk and for corn and soybean feed costs. Again, from an affordability standpoint, this program has premium support that is up to 50%. So again, similar to dairy revenue protection, this program, based on the total cost of coverage, that USDA support would make it half of that cost back to the dairy producer. Moving on to the dairy margin coverage, which replaced the margin protection program. This is the most widely used dairy risk management program, specifically in the Northeast, with over 70% of dairy operations enrolled for 2021. And this program is available through the Farm Service Agency, protects the margin between the all milk price and average feed price. This, whereas dairy revenue protection and LGM-Dairy provide a lot more flexibility on when you can enroll and more opportunity to look at how the market is responding, prices and what futures are looking like. This is an annual election. I believe the last election that we had was required to be made in December of 2020 for the 2021 year. So that is one of the limiting factors as to the time frame that we have to look at the market and make decisions. But again, with the options that you have and the affordable cost, this is a very solid, important part and should be a part of your dairy risk management plan. Coverage levels are really in margin protection, which range from $4 to $9.50 per hundredweight in 50-cent increments. And you have the ability to choose the percentage of your production history that you want to enroll. That ranges from 5% to 95% of your production history. Again, a lot of benefits to this program, and payments are made and determined on a monthly basis. So that's a positive in itself right there. And then if you're familiar with DMC, Tier 1 protects up to the first 5 million pounds and is very affordable. As you look into Tier 2, we don't have that the same margin options to protect as high as $9.50, and the premiums are a little bit higher. But certainly dairy margin coverage should be a product that is looked at closely and will shift into developing a risk management plan and looking at all three of these options. So looking at our conclusion of where do we go from here, certainly establishing a relationship with a crop grower's crop insurance agent, I would recommend as being the first step. Crop growers, our team, we have just over 30 dedicated crop insurance agents throughout the Northeast, including our Yankee Farm Credit Territory, as well as our Ag Choice Farm Credit Territory. Reviewing the available options, what we did today was just a high-level view, a little bit of understanding of each of the products, but really taking the time, visiting with the agent, talking about the details, and then moving into a personalized dairy risk assessment. This is something that all of our team members do on a regular basis, and I would say throughout the year with our dairy customers. So reviewing the operation, understanding their net cost of production, understanding your business goals, understanding your markets, understanding your component values. So the more that we understand about your operation, the better we can develop that plan for you. And if struggling with determining your net cost of production is one of the obstacles that we have to overcome, we certainly have the means to do that from a farm credit perspective. We have our Dairy Profit Analyzer program through our business consultants. Our crop insurance agents can help you with evaluating your net cost of production, determining that, and then our credit staff and other team members. Certainly from a farm credit perspective, having that deep understanding of dairy financials and the full suite of farm credit services that we have to offer, we can certainly help you determine that and then also develop the most sound risk management plan personalized to your business. Another important step here is working with the Farm Service Agency, evaluating the dairy margin coverage program. That has to be an important part as you look at annual risk management planning. And then if we're going back to the Dairy Revenue and LGM-Dairy program, establishing a policy now. And even though you may not be immediately looking at enrolling milk, the last situation that we want to have you in is, okay, it's time to do something. I've got to make a decision. I really need to enroll milk. And we want to make sure that that policy is in place. We want to make sure that you have a clear understanding of dairy revenue protection and LGM-Dairy. And then what this also does is Farm Credit East, Ag Choice, and Yankee have an industry-leading dairy revenue protection analyzer tool. Currently, we have just about 350 operations that are in this program. This tool allows you to perform what-if scenarios. It looks at market dynamics, so it looks at the history of Class 4, Class 3, all of our component options, and then helps you make the best decision possible for enrolling in dairy revenue protection. And in fact, we've actually just added a livestock gross margin dairy analyzer to this tool, which again will help you make the best decision for your farm. And when you have enrolled milk in real time, you'll be able to track how that endorsement is doing in comparison to futures. So very leading edge program, really excited about it, really excited about how it's helped dairy producers make better dairy risk management decisions. And then just 2 weeks ago, we made a formal announcement that pretty much the same functionality that is in this tool is also now in your hand with a mobile app. So really excited about that. Looking at where do we go from here in establishing a relationship with a crop insurance agent, one key part is establishing a contact strategy plan. So does that mean meeting quarterly? Does that mean setting a price trigger within the tool that we have, the analyzer tool? If you want to set up those quarterly meetings with a crop insurance agent to review the markets, review the business, review the net cost of production, that's a great strategy. Or if you want to take another path that says, I want to put a price trigger of $18.50 for Class 3. And when that price hits in the futures, you will be notified through a text message notification, and your agent would be notified. And that tool in itself will trigger it's time to have a discussion. So certainly from a product knowledge perspective, from a technology tool perspective, we've got the means to put you in the best position with what all dairy risk management plans should be focused on is how do we maximize profit while at the same time reducing business risk. Kyle, I'll turn it back to you.
All right,
We
good
can see
morning,
your,
everyone.
and we can see your screen, Catherine.
Excellent. Thank you so much. Well, good morning. It's a pleasure to be a part of this webinar this morning. Let me see if I can get, there we go. Well, it has been quite a year for us. I have been thinking about the dairy marketplace as really one big game of tug of war. And I think we are still very much in that. And, you know, as Chris alluded to earlier in this call, the winner of that tug of war game this past year and really into 2021 has been demand. Demand has been very strange, but I agree with Chris that we as an industry have done a tremendous job at dealing with the struggles put in front of us and are much better for it. So today, you know, we have, thanks to a successful vaccine rollout, we are starting to get back to normal and demand is improving, and that's a great thing for dairy consumption. What was very interesting about last year was that we had a whole new bucket of demand that we had never really had before, which was, you know, government purchases. Food service, retail, government purchases, you know, those became the three that we had to keep track of. I think where we are today, of course, we know that the government's role is diminishing. It is a bit uncertain, but I don't expect that we are going to see anything near what we saw last year. We have been aware and recently received another update that there will be a 400 million dairy donation program that's in the works, but the details are still unknown. So how that impacts the marketplace is yet to be seen, but again, I don't think it's going to be a huge player in what we see and how it contributes to prices this year. So demand, I would say, overall just looks so much more improved. And to put some numbers on it, if we look at the commercial disappearance data that we have thus far for the year, January through April, really you can see nearly all categories have shown improvements. And on a milk fat basis, we're seeing commercial disappearance up a little bit over 4%. So demand is in a good position. Now, in that commercial data disappearance, included in that is dairy exports. And now that exports are a much bigger part of U.S. dairy's portfolio, now, you know, 15 to 20% of our products going overseas, we have to really keep track of what's going on in those dairy exports because they drive our prices quite a bit, particularly in the non-fat and the whey category. Now, to give you a feel for kind of where we are, we saw a tremendous month in April. On a volume basis, we were up 32% versus the prior year, and on a value basis, up 25%. But still looking at year to date, those numbers are still pretty positive, 14% and 11%. In the non-fat category, we've continued to see some improvements and steady purchases in that category. It had been primarily going into Southeast Asia. We've seen those back up a little bit and starting to see some improvements coming out of Mexico, which is really good. Looking at the whey category, that has been really consistent. We see April looks very similar to what we have been seeing. China is the main factor there, buying a lot of dry whey product going in to feed their hog population. A couple of the more interesting things I think that are worth noting are on our less traditional export products, cheese and butter fat. Cheese, we saw a nice jump this past month, and you know that is attributable to Mexico coming back in the game, also seeing some, you know, a significant amount of sales going into Japan, Central America, and South America as well. And butterfat's also a, you know, really strong number there, and it's worth noting. And I'm showing you a graphic here on the left-hand side of our screen to just show, you know, compared to past years, how remarkable those butter export numbers really are. Now, I think the reason behind those butter exports is primarily due to us, the U.S., having a competitive price and having that competitive price for a series of months in a row. So this is really helpful to the butter scenario, but I do want to mention that if you think about butter exports as compared to the whole butter category, we're talking 3–4% of butter is going overseas. So this is really helpful, and we'll talk about butter a little bit later, but just wanted to give you some perspective there. Looking at dairy exports just kind of on a country basis, you can see kind of some of those comments I made earlier. Southeast Asia has backed off a little bit, but interesting to note that Southeast Asia has last year took the seat for #1 export partner. We had been looking to Mexico for quite a few years, but that has changed. Mexico last year had a heck of a time with their economy. They struggled with COVID. Purchases went way down, but as I mentioned, we are seeing them come back, purchasing in that non-fat category and in the cheese category. And then lastly, you can see China, which I've been talking about. China has really been on a shopping spree. They have been buying a tremendous amount of product, dairy and otherwise. We do expect that that will likely come off a little bit, especially as we get towards the end of the year. But for the time being, that is really supportive of prices, particularly in the whey category. So if demand was the leader in that tug-of-war game last year and the beginning of this year, I would say at this point in time, for the last couple of months, we have definitely seen a change of pace. And that milk production, the supply side of the equation, is now the leader. And I think probably the single biggest factor that we need to look at and be a little bit worried about at this point in time. So what I'm showing you here is how we've seen milk production change over the last year or so. And you'll notice, of course, you can see that time period in May where we had, the crash in food service, the crash in demand in life as we knew it, the co-op responses, the farm responses, and supply came down. We have since recovered quite a bit, and if you look at where we're at for May of this year, we are looking at production up 4.9% as compared to a year ago. That 4.9% is looking at the top dairy producing states in the country. That might seem like a bit of a wonky number because we're comparing it to such a crazy time period last year. But even if you kind of compare numbers to where they were in 2019, we'd still be in an over 4% growth period. So as I'm sure you all know, when we get milk production rates above the 2% mark, we start to get a little bit nervous on the impacts that this is going to have on pricing. The other thing I want to point out in this graphic here is how we've seen milk production vary over the course of the year. The blue section is showing the herd size, cow numbers. And that's been pretty steady, but notice that we're starting to grow and grow and grow. And where we're at now, I think we're actually the largest herd in about 25 years. So we have a lot of cows. The orange is the yield factor. And that's where we've seen most of the variability, and I think where we have the potential to see increased variability moving forward. Oops, sorry about that. So, I think the biggest question is, okay, we're concerned about milk production. That is a growth rate that we do not want to see from a pricing standpoint. Will it slow down? There's a couple of factors out there that would indicate that we should see it slowing down. Number one would be what we're seeing with feed prices. Feed markets are just doing very well. Exports have been wonderful in that regard, but of course that's been driving up the price. And feed prices are at historical highs, and we're looking at almost double what they were last year. Now, we have seen those futures come down quite a bit in recent weeks and months. That said, they are still historically high. We also know we're in an inflationary period right now, and we're seeing input cost across the board going up. And so that should signify that margins are getting tighter, and we would expect to see that that pressure would result in a decline in milk production. We're also looking at drought conditions, severe drought conditions, particularly in the western part of the United States. And with that, that of course could also have some negative milk production issues as well. So maybe, maybe not does it slow down, but I think what I would caution, even when we think about some of the factors that would push us to think we would see contraction, is that with a herd size this large, where that contraction is likely going to occur is on that yield factor and probably less so on the cow numbers. So we have a lot of cows, we have a lot of milk, and that of course means we have a lot of dairy products out there. Now, you've all probably heard that we've seen a lot of changes in manufacturing and additional processing capacity in the cheese space this year. And so where we are seeing a lot of that milk production growth go into is these new homes making cheese. Now, looking at American cheese production, you can see that we have seen a significant amount of growth in the last few months because of those new plants and new capacity. We're looking at cheese production, American cheese production, up 6%. It's a big, big number. Now, we've seen demand for cheese throughout the pandemic be fairly positive. You know, QSR types of restaurants were the ones that we were continuing to see, and those benefited cheese as compared to other dairy products. So demand is still good. We're seeing some of those exports like I talked about, but it's not quite good enough to offset the cheese production that we're seeing. And what that's translating into is some really pretty high stocks of American cheese. Now, the latest number is only up 1.3% year over year, but if you look at that comparison to 2019, I think you can see that I'm a little uncomfortable with those stocks and what those mean for prices. Prices right now on a spot basis are really unimpressive. Sub 150 is not a great place, not a place I want to be. We are seeing some improvements as we look toward, into the futures, but we're seeing a lot of volatility in the last couple of weeks and months. Blocks and barrels, you'll notice, are now much more aligned than they have been in recent years. We had been dealing with 20, 25 cent premiums for the block as compared to the barrels. And now we've seen inversions of that. And so I think that we continue, at least in the short term, to see some volatility and some bouncing around between blocks and barrels. But as we get, out of the next couple of months and really into that September and beyond time period, that's where I expect to see that we see some improvements in those prices and a little bit more consistency in that block barrel relationship moving forward. Interesting, in our class 3 space, we have our cheese and we have our whey. And this year, the last couple of months, we've seen that whey prices have really been helping offset some of those challenges that we've been seeing in the cheese category. Dry whey as a commodity, we haven't seen much production of dry whey. And that's because we're seeing a huge amount of demand for higher protein products of whey. Whey protein concentrates, things along those lines. And, I think that goes to just consumer demand. We see that consumers throughout the pandemic, and now that we're getting out of it, are really concerned with health and wellness, kind of getting their beach bodies ready now that we're out of this pandemic situation. And so a huge amount of demand for high protein whey products. And what that's doing is pulling whey out of that dry whey stream and really supporting that price. I also talked about the exports that we've been seeing going into China that are supporting that as well. So overall, feeling pretty good about where whey is. Do see it coming off as we get in towards the later part of this year, but overall pretty supportive and supporting that class 3 space. Moving on to class 4, butter production, you can see, looks a little bit different than what we saw last year, down 18.5%. But of course, what did we do last year when we lost all of that demand and supply chains went crazy? We put the milk into butter powder plants. So we would expect to see that number. What that change did last year, that all that milk going into butter production, meant that we saw a tremendous amount of butter not sold and going into inventory. And those inventory values are really important in the butter space, and we look to cold storage numbers as an indicator of what prices are going to do. And so looking at butter, so long as we have burdensome inventories, we are going to see butter prices really struggle to get back to those over $2 numbers that we've become accustomed to in the last couple of months. That said, I'm fairly optimistic about the butter category, and part of that goes to just the demand improvements that we're seeing. You know, a little part of that is the export improvements that we've been seeing, but we're seeing demand in other categories such as cream cheese and ice cream that use a lot of butter fat and are pulling that cream into those products and away from butter. And so I think that that has the potential to, you know, all those factors really have the potential to help us work through these butter inventories. And, you know, I think that by the time we get into the beginning of next year and really halfway into next year, we probably have worked through those butter inventories and are back into a more comfortable butter price over $2. Now, lastly is the non-fat dry milk category. And overall, this category has been pretty strong. Now, most of this product is going overseas, so we have to, this is why I mentioned the export factors. Seeing improvements in Mexico, seeing Southeast Asia come down a bit, but overall still pretty good. I think that we continue to see some modest growth in this category. We've been flirting with that 130 price, haven't quite got there yet, but we're getting close. And so I think that we continue to see some upward movement here. The other thing, you know, thinking about the drought that we're seeing in the western part of the state, that could potentially, if that slows milk production down in the western part, could also slow production of butter and non-fat as well, and that could be supportive of the class 4 complex going into the future. So overall, you know, trying to give you a feel for where we think prices are going for the next, you know, 6 to 12 months, you can see here where class 3 and class 4 are going. And notice where we were. It was quite a volatile situation, that class 3 price moving all over the place due to the food box program. We don't see that volatility continuing, at least to that degree. You will notice that as I mentioned, in June and July, we do see that because of cheese prices coming off a bit in those futures, we do see the class 3 space losing quite a bit of momentum from where we are here today, but we see it recovering as we get back into the fall and that holiday demand period. Again, notice that class 4 is becoming, this is where I'm a little bit more optimistic, and class 4 is very much getting right up and close to where the class 3 is, especially as we get into next year. And I mentioned this relationship because I know for producers out there, there's been a lot of heartburn about negative PPDs and, you know, trying to manage risk while you have all of this volatility. And, you know, our expectation is that a lot of that goes away, and we see that these normal pricing relationships really, you know, get back in the next couple of months. So blend price forecast, you know, we're looking right now, we're, you know, over $18, as I mentioned. We saw that pullback, that retreat in cheese prices, so that is going to probably bring us down into that, you know, $17.75 range for the next couple of months. But then again, we see this upward trajectory and looking, you know, just over $19 for the second half of this year and getting into next year. So to summarize, we definitely have, in my opinion, shifted away from a demand-focused market and into a supply-driven market. Lots of milk out there, plenty of product out there. Demand is good, probably not seeing the government involved to the degree it was. We see exports helping for the time being, and in the short, we'll see a little bit of a price retreat, but definitely improvement on the longer term. Margins are going to be tight out there on farms, so though milk prices are improving, we are concerned about what the margin situation looks like. But again, still remains a question whether that milk production responds to those tight margins and the drought conditions, or if it keeps on plugging away. And with that, I will say thank you and pass the baton.
Okay, Kyle, I'll moderate the questions if that's okay. We have some interesting questions that have already come in. And for those of you that would like to submit questions, you can through the GoToWebinar control panel. If you just click on the right-hand side of your screen, the little arrow, it'll expand it, and you can open the question box and type them in. So I'll take the first one. It's, does non-milk income include CFAP dollars? And I'm guessing that this is a question about my net cost of production calculation. And the answer is no. We take out government payments when we're considering the net cost of production calculation. We include non-milk income of crop sales, cattle sales, and if there's an ancillary business activity that's integrated with the farm, such as like mapling or something like that, we include that revenue. We do not include government payments in the net cost of production calculation because it doesn't cost you any less to produce the milk just because you got a government payment, basically. Government payments are included in the income tables, you know, in the book and that kind of thing, but not in the net cost of production calculation. So hopefully that answers that. The next one is, did milk quotas and penalties have a significant effect on production and or net income? I'm gonna let Catherine maybe speak to this, but I will preface it by saying that the impact of quotas and penalties and base excess programs and that kind of thing were really pretty variable. They varied by milk buyer and cooperative and that sort of thing. And additionally, they varied based on the farm situation. You know, the idea was that they discouraged expansion, but they didn't necessarily hurt a farm that wasn't expanding in most cases. So, Catherine, maybe you can expand on that.
Yeah, sure. I would just, I would echo everything that you just said there, Chris, that it was very specific to your cooperative and what the program was. In the early days, back in April and May, when we saw that initial disruption in the supply chains and massive base excess, quotas, supply management, whatever you want to call it, programs come into place, we saw a tremendous impact on, how production shifted nationally. And I think I showed you that in one of my earlier slides with milk production. You could see it come down quite a bit. And that had an impact on prices right away. We hit our lows and all of a sudden, we took off. But beyond that, those programs have varied so drastically throughout the country, and they've done that because it really is a function of what is your processing capacity in your region. And the goal has been to not dump milk in the ground and align, your member supply with your capacity. And in areas where capacity was not a limiting factor, there was no reason for cooperatives to put those programs in place. But in areas like the Northeast, where production capacity is a limiting factor, those programs have had to continue, and that has been a challenge that farmers have had to deal with and be part of their business strategy and a determining factor if they're going to, how they are going to react.
Thanks. That was a really good information. It certainly didn't have the effect of reducing production for the year nationally. We were still up in terms of milk production. It may have temporarily in certain regions had that effect though. Next question is, with the cost of inputs rising in 2021, how do you anticipate that will impact fixed and variable costs? We see similar costs as we saw in 2015, according to the slide you showed in your presentation. Certainly, usually profit analysis or profit, the thought process of earnings for most dairy farms is usually focused on the milk price. In 2021, it's all about the input cost calculation. And it variable costs substantially, cost of feed, cost of labor, other inflationary things. It'll impact fixed costs perhaps to a lesser extent, but still if a farm is doing any any expansion or any construction or, even repairs and maintenance, all that stuff is more expensive than it was. And that's, I think, maybe Jeremy, you could speak to this a little bit. That's why these risk management programs that are based on margin are especially useful right now.
Absolutely, Chris. And you look at what we have available through LGM-Dairy, and don't get me wrong, the dairy margin coverage program, that should be a staple and a mainstay to dairy operations risk management plans. But you now look at LGM-Dairy, which is looking at both sides of the equation and has even more flexibility going forward with a weekly enrollment. Yeah, this needs to be a part of the evaluation process when executing a risk management strategy. So thanks for pulling me in on that.
No problem. And another one for you, Jeremy. You mentioned several risk management programs. Can you participate in more than one at the same time?
Great question. So regarding if you have a dairy margin coverage plan in place, you are able to participate in both dairy revenue protection and livestock gross margin dairy. So your participation with the FSA program does not impact any of your participation in those two programs. If you participate in dairy revenue protection, you just can, and vice versa, so you just cannot enroll in the same quarter an LGM-Dairy endorsement. So the only impact is we can't have dairy revenue protection and livestock gross margin dairy protection within the same quarter. Great question.
Okay, and so a little bit complicated there, but can I assume that a crop grower's agent can explain that if necessary to a producer?
You bet, Chris. Yep. And so it's in our fact sheets, and that's a part of the evaluation process and developing that personalized risk management plan. We're going to make sure that we look at all options, all the products that are available, and how do they work if they need to, how do they work together, or what, based on what the market's looking like, what your business assessment is coming back, what is the best option? So yes, a crop grower's agent can walk you right through that step.
Okay. Question for Catherine. Feed forecasts seem to be flat despite the concerns on 2021 crop yields, droughts, rising grain prices. What is the rationale for the optimism, do you think?
Yeah, well, good question, and I'm not going to pretend to be an expert on the feed side of the equation, so take what I say with a grain of salt. But I think at this point it's probably just a little bit early in the year to make an expectation of where we're going. So still, trying to wait for a couple major reports and see how the summer goes before we get there. But that's a good point, that there's just a lot of concerns out there that could move the needle one way or the other.
Yeah, I think all eyes are on the 2021 crop year and crop condition as we go forward. I think there is more risk for feed costs to increase as opposed to risk of them decreasing over the course of the year. Certainly widespread drought, particularly in the West, is a major concern. Crop conditions nationally, as USDA ranks them, are below last year. The crop quality, the percent that's rated good or excellent of corn and soybeans, currently they're a little bit below last year. I mean, but they're not bad, but it's still very early. The crop conditions always start out 90% and then sort of decline based on what happens to them. So we're watching that closely. And another big factor in terms of pricing for grains and oilseeds is what China does. And they're very unpredictable. Some of the rise in crop prices has been based on, as Catherine said, a buying spree, not in dairy products as well as grains and oilseeds. We don't know whether that's going to continue or not. So good questions. If there's any more, please chat them in. We'll we'll go for a couple more minutes. Catherine, any, based on your forecast, do you have any sort of takeaways for producers as far as things to think about going forward?
Yeah, well, I kind of mentioned a few of these, but I think, my number one takeaway is, well, there's still volatility out there in the marketplace. We all talked about that here today. But where we think we're probably headed is into a more normal situation on the demand factor, bringing that food service back, retail continuing to be strong, government purchases mostly going away, and much of that volatility that was created because of the disruption in demand is probably also going away. And so I think when producers look at their milk checks, they should be expecting normalcy in there, at least, towards the end of this year, which I think is welcome. Maybe we would like to see those, or we would all like to see those prices higher, but that normalcy is going to be, I think, a sigh of relief, especially when we start thinking about risk management and trying to make the right decisions and working with, Jeremy and his team. I think that normalcy is going to be really important. Where I mentioned this already, but I see more potential for upside on the class 4 side than I do on the class 3 side. And that's primarily because of what we're seeing on the supply side of the equation. So all eyes on milk production.
Okay, great. So with that, I think we'll wrap it up. A couple of comments here. farmcrediteast.com/webinars is where all of our webinars live, past, present, and future. So you can go to that link at any time. You'll see any future webinars we have scheduled, register for current upcoming ones, as well as see recordings and presentation materials of past webinars, including this one. The recording and materials should be posted by the end of the day tomorrow. It takes a little while to get it up. But another thing is on our website under the Knowledge Exchange tab, we have a COVID-19 resource hub. I know COVID-19 is kind of receding, but there's still relevant information on there that's being updated as we find out about various relief programs and what's happening. So with that, we will sign off, and thank you very much for your attention and your attendance.